Hey, good morning, everybody. Hope you're doing well on this Saturday morning, getting last minute stuff done for all your Christmas shopping. um, so we're getting ready up here in Maryland, but yeah, today I gotta apologize. I wanted to do a bigger presentation, but December is a very busy month. Just lots of last minute maneuvers and tax projections and forms that have to go out, and Schwab, getting used to Schwab still, not really loving it. They're definitely harder to work with than, say, TD Ameritrade was. So still looking for that final home, but I'll keep you posted on what I'm looking. Still just not finding the right perfect fit yet. So it's not something you want to bounce around to. But anyway, so this was supposed to be kind of like, all right, we're heading into the 2024. This is our last Coffee with Kirk for the year. So I wanted to do kind of sort of what I see, but again, it was kind of strapped for time. So I'm going to just kind of go through some of the stuff again, why I kind of see, I still think a recession. And I totally could be wrong. I've been wrong so far. I thought we'd be probably in it by now. The lag between some of these indicators that have gone south and the manifestation of a recession hasn't happened yet, but it's still just, things just keep piling up. It just feels like what it did in 2000 and 07. And again, when I say 07, people start thinking 08 and they get freaked out. I'm not saying we're going to have something like that. But, I do kind of think we're going to see some bumpy roads ahead. And I'll just go through it. If you've been coming in every time I hold these and watching replays, it's probably not going to be a whole heck of a lot of new stuff coming at you. But I'm just going to sort of recap the big reasons why I think we're sort of heading that way. So as always, I'll pop up my screen. Hopefully it works here. Okay, so we'll just kind of quickly go through. Hang on a second. So just some of the things again. Why am I so hell bent on on recession? There's so many people. If you watch CNBC, CNBC always brings on bullish people. That's what the mainstream media, especially financial media, that's what they always say, and they could be right. They could be right. But I kind of follow some other people, and I particularly follow people who aren't always bearish, aren't always bullish, and have actually done a pretty good job of calling this stuff in the past. So this isn't something that I'm creating myself. I'm really kind of following people smarter than me, if to put it bluntly. And then I just try to learn as much as I can from them. And then as I see the trends, sort of convey them to you all. So I've been talking about this a lot the past year. So there's three sort of indicators that you look at when you're looking at the economy. There's leading indicators, which tell you where you're going. That Wayne Gretzky quote, "Don't skate to where the puck is, skate to where it's going." And that's what leading indicators tell you. Then there's coincident indicators. So that's where the puck is today. That's where things are right now. And then you have lagging indicators. Those are things that sort of eventually show up after we're either fully in the recession or actually coming out of it. And the biggest one on the lagging indicator is unemployment. And that's the one that people always look at to gauge if we're in a recession or not. But that's not how people should be looking at it. So the leading indicators, there's a lot of different things here. You're looking at sales, you're looking at durable goods, which are, washing machines, refrigerators, things along those lines. It looks at financial conditions as far as how easy is it to access money, what's the cost of money. So a lot of the things that tend to affect the economy in advance. And, we've seen now just numerous months where we have continuous consecutive declines in the leading indicators. So, typically when you see this, you're going to have a recession when you see them this big. There's periods where you have a little bit of a spike, but you still go into recession. Like 2001, we didn't see that many months of the leading indicator in a negative fashion before we went into recession. So, this one kind of correlates with the financial crisis of 2008 and then the early 1970s. That's how many months we saw, leading indicators declining. So like I mentioned, sales, revenues, things like that. If you're a big enough nerd and you follow companies where they do their conference calls when they report quarterly earnings, or if you look at the regulatory documents that they issue showing their revenues, 10Qs, 10Ks, you're going to find that a lot of the companies aren't producing more revenue. They're doing a very good job of working on their earnings after the fact. So cost cutting, all these other things that they might try to do, reconfiguring the business, everything like that to improve their earnings. But their top line sales is not climbing. And this was just a chart for small businesses. You can kind of see small businesses, are starting to feel it a little bit too. They're seeing their revenues dry up. Manufacturing is a huge part of leading indicators. So manufacturing, as all of you know, when you produce a good, product, a car, a refrigerator, everything like that, you still have quite a lag time until it actually gets distributed, to where it's going to be sold and then to the end consumer who actually pays for it. So when manufacturing starts to slow, that's usually a leading indicator. They're just not seeing the demand for their products. And that's been, we now have 12 months so far where we've been below 50, which is anything above 50, manufacturing economy is expanding. Below 50, it's not. So when you get this many months where you've had manufacturing contracting, that's usually kind of it should be a red flag there. Shipping, if you know any people who are truckers, it's getting to be kind of a tough environment out there. So this thing, basically, I'm not going to go through it, but if you just sort of look at the numbers, you'll see for the most part, lots of negative for all different kinds of trucking. And now part of the negative, and when I say negative, I'm talking about this is prices. This is prices compared to previous years. So it breaks it down, October of 23 versus October 22, October 23 versus September 23. So that's a much shorter. So, and then from November, comparing it to, we're looking at weeks, and it's hard to find data on this. Most of the good stuff is behind paywalls. But the big thing is you just see that numbers are kind of negative. Now, part of that too could be because oil prices have come down. So the costs have come down because of oil. But if you look at the very bottom line, you can see fuel prices. And, they haven't come down quite as much as some of the other types of shipping. So we're seeing less truckloads, being utilized right now. So the biggest reason you see prices come down is one, gas prices come down, but two, just demand. If demand's lower, people are going to lower their price to entice people to hire them. So we're seeing shipping, which is a big leading indicator. Cargo ships, everything like that have been slowing down. Another big one is tax revenues. So I had one that showed I had a chart with the federal Revenues there also coming down, but this was one I just found recently for state and local governments. So they are seeing their tax revenues drop. And it's just a sign that, the government is on the tail end of everything, right? They are the ones who essentially parasitically suck up what we produce. So all of us who aren't part of the government, when we're producing goods and services, the government's going to get a cut of that. So if the government revenues are coming down, that typically means that the total amount being produced, the total incomes, everything like that has to be going down. It's the only way that works. And, unless there's massive tax cuts, that could also cause it to drop. But we really haven't seen any kind of tax issues as far as changes nationally or even at the state level for most states since 2017. So this just kind of tells you, look, the revenues are dropping for the government entities, which has to mean that on the aggregate for the economy, things are dropping. The other thing I talk about a lot is there's really two different ways that we measure what the economy is doing. There's gross domestic product, which gets most of the press. And then you have gross domestic income, which is a little bit of a deviation. And it's trying to say, what is the total income of everybody within the economy? That's essentially what they're looking at. And you can see historically going back, this goes back to early 90s, but for the most part, they tell the same story. They're not always in lockstep. In fact, they're probably never perfectly correlated. But at the end of the day, they get to the same spot. One may be leading the other. Well, we do have a pretty big deviation right now between gross domestic product and gross domestic income. Gross domestic income is actually negative, whereas the GDP right now is positive. Again, one of these is telling the right story, one of them isn't, or it could be something in between them. But they'll get to the same point at some period down the road. The correlation is a little bit bigger, or I should say the difference between the two right now is much larger than what you've had in the past. So something's got to give here. And gross domestic income, I like to use that one a little bit more, only because it shows what's the total income, what are the total profits of companies, and what are the incomes of the individuals within the economy. Gross domestic product, I feel, could be manipulated a little bit more because, they have an inflation adjustment. So they try to say, okay, this was all the goods and services produced, the gross amount, and then they adjust it for inflation. But if the inflation adjuster is a little bit off, then the GDP is going to be off as well. But at the end of the day, the big takeaway is, GDI is going down. It's in negative territory. Is GDP going to follow it, or is GDI just a little bit down right now and it's going to pull back up to GDP? Historically, these things are going to meet at some point, so we'll see what goes on. But as far as a leading indicator, GDI is kind of telling a sort of a story. Now, I've always said that the lagging indicator that everybody looks at is job losses. And it's something that they really don't pick up until we're well into the recession, or even sometimes pretty much through the recession. That's when you see most of the layoffs. But we're starting to see some cracks in the job market. Not to the point where, it's making the nightly news, nothing like that. But we're seeing definitely a shift, a change. So year over year, job losses is starting to climb precipitously. Again, it's not in recession territory yet. It's not even close, but it's a trend that I think sort of backs up some of the leading indicators. You start to see this at some point. And another big one is temporary help. So there's a lot of outsourced help agencies that, okay, we might only need people for 2 or 3 months, or we're so busy in the office that we need to get somebody in here to help us. We don't have time to really vet, potential employees for a full-time hire. So they use temp organizations, and they do a lot of the routine, mostly admin stuff, or maybe they have a specialty that they just come in. If you're, if you're in some sort of manufacturing, you might bring some folks in who know certain aspects of manufacturing. Same with shipping, all kinds of stuff. But basically, it's just temporary help. And you can see coming out of the pandemic recession, employees were really hard to get. So there was a huge demand for temporary help. But we're starting to see cracks here. So companies aren't hiring temporary employees. And that typically is the first thing that you'll cut. If you're not so busy in the office that you need help, or if you just don't have as many hours available that you need employees for, temporary help is the first one you're going to cut. And we're starting to see some cuts there. And another thing here is, this was a chart that's put out by Crescat Capital. Tavi Costa is somebody I follow a lot. And basically he's looked at is anytime you start to see the unemployment rate cross its 24-month moving average, almost every time it has resulted in a recession. So, and we've just recently, I think it was in October, we recently just hit that. Again, it's not saying we're there. You can see we're still pretty low, but it's just trends. You're looking for trends. Where are things going? And this was a little paper that he put out and just talked about what's the typical process for, employment. So he's got red and blue here. So red means things that have already happened. Blue is things that are sort of in motion. So, the first thing is just sort of employment starts to slow a little bit. And then the first thing companies do is they reduce the overtime hours for people because, well, why would you pay a higher rate for overtime if you don't need quite as many hours? And then you cut temporary staffing. That's the next move that typically companies make. And then they start to go, okay, well, let's look, we're going to cut everybody's hours. So people who are hourly employees start to see they're not getting as many hours as before. And then what you start to see is, again, labor demand and hiring really starts to slow down. Continuing claims, unemployment claims start to go up, which they're starting to do. Duration of unemployment maybe stays a little bit longer. So somebody who maybe got employed last year and within a month or two, they're back into another job, that might take 4 or 5 months to get a new job. And then finally, the last thing, you start to get to sort of a permanent job loss. You're seeing just that jobs are starting to go away. And then the things we haven't seen yet is, labor hoarding into early recessionary period. And then finally sort of a payroll capitulation where you say, look, revenues are down. We got to cut people, because usually people is the biggest expense that companies have. So we start to see that there are some cracks there. It's not at what you'd see at the peak of recessions, but again, we're trying to look for trends. And the thing is, at some point, this is a chart just showing the S&P 500 versus job openings. And job openings, are starting to be harder to come by right now. So this isn't perfectly correlated, but, the market's up pretty high. One of these is going to track the other at some point. You can see, while not perfectly correlated, they do tend to rhyme. Okay, so that's the economic indicators. And then the other thing that I've been saying all along is we have, since really 2009, had very accommodative monetary stimulus. So what happens when you have markets, whether it be stock markets, bond markets, real estate markets, pretty much everything has had a massive tailwind due to accommodative money, easy money, rates near 0%, mortgage rates at 5% or below for most of those years. So when you have cheap money, what happens when that money starts to get more expensive? How does that impact the economy? And you can't expect to have a tailwind, like easy money, all of a sudden turn into more difficult money, harder to come by money, higher cost for money. You can't go from a great tailwind to a headwind and expect that nothing's going to happen. That just doesn't happen. So you're going to have some manifestations. One of the big things is M2, that is basically a measurement for all the money out in the economy. And that's the red line. This chart's a little blurry, I apologize. But M2 has been shrinking for quite some time now, really since the Fed started raising rates in early 2022. And then, what's going to happen with, CPI? Typically what you're going to see with inflation, when you pull money out, prices are going to go down. And we've been talking about really for about a year and a half now. I've been saying my long-term thesis is inflationary. So I'm thinking the next 10, 15 years, there's going to be more periods of inflation than deflation. And again, the reasons I've said that is we've got that tailwind of outsourcing is basically gone. So really from the, really mid 90s, when we started to outsource to China, we had a tailwind because costs of goods and services didn't really go up as much because we were able to outsource, to Chinese workers. Well, that's kind of come to the end for two reasons. One, we've outsourced so much to China that they don't have the capacity to keep their employment costs really low. But secondly, we've started to realize that, we need to bring some of this manufacturing back home, because right now China shut down the flow of goods. We're in trouble. I mean, everything is basically coming from China, and things you wouldn't even think of. Medicines come from China. Obviously durable goods come from China. Tons of that stuff come from China. But if they cut us off, we would be in a big hurt. So even the idiots in DC are starting to realize this. They did the CHIPS Act last year to start to bring home manufacturing for microchips, computer chips, all that good stuff. But we're going to see more and more manufacturing come back. Even if it doesn't come here to the United States, it's going to come here somewhere, maybe South America, Central America. We've just realized we can't have a 7,000-mile supply chain that's controlled by probably our biggest enemy. So that's going to be inflationary because we're going to be paying higher wages. We have to build new factories. There's a lot that goes into it. And it's not something that's going to happen in 1 year. It's something that's going to happen over 10 or 15 years. Now, the other reason I think we're going to see inflationary over the longer term is just the fact that we've underinvested in the commodity infrastructure. So we have been, certainly been pushing solar and wind, but to the detriment of everything else. We've been really fighting natural gas and oil. Certainly coal has been on the naughty list for a long time. And we've even ignored things that are actually probably the greenest and most energy-dense energy sources, nuclear. But that underinvestment is going to have a huge impact on us over the next 10 or 15 years because our demand for energy continues to go up. But if you create a situation where the supply is not keeping up with that, you're going to have higher costs. So that's another reason why I think over the next few years, we're going to see inflation. Now, why am I going on about this? Well, the thing I've said all along is I think we're in a longer term inflation, but I think because of raising the rates like the Fed has, pulling liquidity out of the markets, out of the economy, we're going to see little periods of deflation every so often. It's probably going to be inflation, and then they'll attack inflation by raising rates, pulling liquidity out of the markets, which creates deflation. So it's going to be a back and forth. Longer term trend would be upwards according to inflation. but you're going to see periods of deflation, and recessions are typically very deflationary. So the price is coming down right now. People are applauding it, and it's good for us as consumers, absolutely. But what's the cause for it? Well, one of the reasons is money supply is coming out. Liquidity is leaving the markets. It's leaving the economy. And that just means that, that's a deflationary effect. And it's also a recessionary effect. So while we applaud prices coming down, we have to realize it could be for a very bad reason. It could be because we're heading into recession. You don't usually have a booming economy and you see prices of commodities go down. That doesn't happen unless you're producing enough commodities to keep up with the demand so that you don't end up having price increases. So the fact that we have less supply, due to government action, and we see prices come down, it tends to, at least for me, it tends to say that the economy is not as strong as we think. And, like I said, the Federal Reserve is even reducing the size of their balance sheet. So they are selling assets that they've got on their books. So they've got tons of mortgage-backed bonds. They have treasuries. They have assets. So they're selling them out to buyers, to banks, to primary dealers, to all the parties that buy from the Fed. And then the Fed gets all this cash in, which they sort of retire. So we're pulling liquidity out of the economy. And the thing I've been talking about too for a while, sort of proof of this happening, is we've had an enormous bond inversion. So to refresh your memory, an inversion just means that shorter term bonds have a higher interest rate. They're paying more money than longer dated bonds. And that's not normal. I always use this example, but if you were going to loan me money, you're probably going to ask for a higher interest rate from me if you're loaning it to me for 10 years as opposed to 10 months, because the risk that I default goes up over time. And secondly, you need a higher rate because of generally you have inflation. So, getting a lower rate for 10 years doesn't make a lot of sense if your dollar is going to lose purchasing value over that time period. So usually an inversion, with the exception of one time in our history, every time the bond market goes into an inversion, we end up going into recession. Because basically what the bond market's saying is that the longer dated bonds are below short term, because what it's saying is we expect slower growth down the road, which that's why we see this happen. And right now it's happened mostly because the Federal Reserve on the short term end has raised rates so fast. But the problem is the recession usually comes once the inversion is corrected. So once the Federal Reserve, who has raised rates precipitously, decides to bring rates down, and they usually do that once they start seeing problems in the economy. And I've used this slide before a couple months ago, but this is true. We've never had this long of an inversion. So you have to wonder, is this just a fluke? Is this the second time in our nation's history this has happened? Or is there really something here? And, I've also shown this before too, just how fast they've raised rates. Maybe it didn't get up to 18% like it did in the late 70s when Paul Volcker was a part of the Fed. But the speed at which they pulled rates up is rapid. And that's going to have an impact on the economy. And it's going to take a little while for it to really, truly manifest itself. But we're starting to see that happen. I mean, look at home sales. We don't have a lot of inventory, but, we don't have any buyers even for the inventories out there. And there is a lag effect between the inversion, typically about a 15-month lag from the first inversion until you hit recession. And honestly, we're actually a little bit past that. So we'll see what happens. I don't know. Maybe I'm just reading the tea leaves wrong. I'm not sure. But if you look at the financial companies, their stock price, they've been getting hammered due to this. This is Capital One. Whoops. I think I mixed this up. This shows bank balance sheets. The bank balance sheets are also coming down. Banks aren't lending as much. So they're letting even debt that gets paid off, they're not putting that money back to work. And again, that's affecting a lot of the financial companies. If you look at the stock price, Capital One again, Citigroup, you can look at Bank of America, you can look at all of them. Where we're at now, Schwab, they're all pretty much struggling. And that's usually kind of a telltale sign when the financial sector isn't really doing that well. Another thing, and probably one of the biggest things I've talked about, is the consumer is clearly weakening. This was just a chart showing the number of times during the last earnings calls. So when the companies release their earnings, usually the CFO, the chief financial officer, and the chief executive officer do a call. And just the number of companies mentioning that demand is weak. So it's going up and up and up. So that's definitely a trend that they're showing, that the consumer is getting a lot weaker. And, consumers are trapped. This is just a chart showing you all non-housing debt. So this is student loans, credit cards, auto loans, and then any other kind of ancillary debt they might have. And you can just see it's climbing quite a bit. And this has a big impact. Maybe it didn't slow down the economy when we had rates near 0%. We just don't have that anymore. And we're starting to see credit card spending relative to pre-pandemic levels. It's starting to go negative. So we're starting to see people using their card less than they were before the pandemic, as far as growth and everything like that. So they are pulling back. And the thing is, like I just said, all this debt may not be a problem if we were, at zero bound rates, but we're not. So the average consumer interest rate now is 20%. Car loans are well north of 7%. Whereas before you could get 0% financing. All of that takes, the more money that goes towards servicing a debt is less money that's going to go into the coffers of companies through sales of their product. That's just how it is. And the inflation especially is hitting people hard because food inflation's been up about 30% over the past 2 years. And that's what people use more than anything else. So this is starting to get to the consumer. It's starting to get there. You can see it. Credit card delinquencies are starting to climb. I can't find a chart, but I've been hearing from people who follow the auto industry that auto delinquencies are going up quite rapidly. And in fact, the thing that's slowing down the auto delinquencies is the fact they can't find repo people. They can't hire people to go repossess these cars, which is kind of an interesting thing. But I mean, that's a very dangerous job. If you're going to go and you jump in and take somebody's car, that's risky. So anyway, you're starting to see things really affect consumers. Interest payments now are really climbing exponentially. So, that we've, for the first time in history, we've surpassed 500 billion of just interest payments. And it's due to the money coming out of the economy. Part of the reason we're starting to see a consumer, part of the reason we saw the consumer strong, and now part of the reason we're seeing the consumer struggle, is the fact that the stimulus that came out during COVID is pretty much gone. When we first got the stimulus, you saw the amount of bank deposits just absolutely skyrocket across all economic demographics. But now we're starting to see to the point where the vast majority, basically everybody but the top 20%, are starting to see negative amounts in their savings. So, if you're listening to this, you're probably somebody who's very interested in finances. You've probably done a good job of saving, and you probably have money in your bank, and you just can't understand that. How can people not have that, especially after the amount of stimulus? I mean, most of you listening probably took the stimulus and it just went right in your bank account. It was nice to get, but it didn't really change your behaviors, but it did change the behaviors of a lot of people. And now that stuff is gone. And that's why they've been hitting consumer debt, credit cards and other debt, because they have to. But that can only go on so long when you have that amount of interest payments. When so much of your income is going towards interest, at some point you're going to have to make tough decisions. And if that's not enough, we're also starting to see home prices start to contract. That could affect people, whether it's through their confidence or the fact that they might not have as much equity to access if they need to. So, this is going to affect the economy too. So if you talk to a realtor, if you have friends that are realtors or mortgage lenders, they've had an awfully brutal year. I know a lot of them are tending bar. They're doing something else. Some people are in a fortunate position. If they're a realtor or lender, their spouse might be doing pretty well. So they've been able to weather it. But, this is a big part of the economy, and it's starting to see some cracks there too. But continuing with the consumer, we're also seeing something that 401k loans are going up. So it's sort of a last ditch measure for people, but you can go in and take a hardship withdrawal from your 401k if you have to. So, it's just kind of all these trends coming together. You see this stuff all heading in the wrong direction is what's sort of leading me to believe it. Now, we've talked about the inversion of the yield curve. And I mentioned already that typically what happens is the recession hits once the Federal Reserve rectifies the yield curve inversion. So once the Fed starts lowering the short-term rates and they bring them below what the longer-term rates are, and we get a normal inversion, or a normal curve, I should say. Once we have that normal curve back, that's usually when the recession hits. What it means is the Fed sees things that they don't like and they start to lower rates. And I think this week was a good week in the markets, because at the beginning of the week, the Fed said they've gone from, hey, we're going to keep rates higher for longer, to they finally said, well, now we think there might be some cuts next year. Well, it could be because they think that they have inflation tamed. Very well could be that's what they're saying. Or it could be that they see a slowing economy and they need to try to get some of the juice back in the economy. But you look at this chart, and every time the Federal Reserve has cut rates, every time they go and do that, usually a recession follows. Because the Fed doesn't cut rates unless they have to, unless they see things going the wrong way. So the fact that Powell, the head of the Federal Reserve, has gone from really very hardcore, keeping rates up, keep rates up longer, make sure that inflation's being killed. So I went from very hawkish to I wouldn't call him dovish, but he's now acknowledging that there's probably going to be cuts in 2024. You got to wonder what's really kind of happening, what they're talking about behind closed doors to go from that so quickly. It could be because they think that they've cured the inflation beast. They could think that. They haven't gotten to the point where they want a 2% rate. We're still, if you look at the rate that they try to look at, which is core inflation, that's still at about 4%. So they're not there. So you got to wonder, why would they start cutting the rates if the rate that they look at, not the total inflation, which is now about 3.1, but the core inflation, which is, your food, your gas, the things that you really need on a daily basis. If it's still at 4%, why would they start cutting? Now, the markets generally, the stock market loved it because they're like lower rates. They love that. The bond market went up, but yields came down too. Now, could that be because they think that inflation's tamed, or are they coming down because usually that's what happens in a recession is bond yields come down. The demand for money isn't there. So just like anything, like I talked about how in the shipping world, one of the big reasons rates come down is because there's not as much work, so they lower rates to draw work. And it's the same for money. So when rates are coming down, typically means there's less demand. So they're trying to find a level that's going to create that demand. So we don't know. But if the Fed is going to start to cut those rates, is it just a precursor to the recession? And this is just an interesting chart that I saw, looking at the S&P 500, and you start to see kind of how things usually play out. So that, the first thing is we go from an inversion, we start to steepen, but credit really starts to tighten, which we are seeing because rates are coming down. And then you finally get the Fed to kind of acknowledge things are slowing. And that's usually where you start to see the crescendo, if you will. So that's how we could expect things to go if, in fact, we are, really entering recession. If we're not, then, then all of this is just moot. Now the market, like I said, the market went up pretty big this week, had a 5% uptick because it loved the fact that rates came down. But like we're talking, usually when the Fed pivots, it's not a good thing. Once the Fed starts to lower rates, it's usually because things aren't going too well. And once you see the Fed start to reduce their interest rate, that's when you start to see stocks come down. And this gives you, everything from back to 1970. You can kind of see what happened every time they started to reduce their interest rates. So typically not a great thing. The Gulf War wasn't too bad, but outside that, the rest of them are pretty solid. And, we could see the same thing, not something like a 50% decline like 2008. When I'm talking about recession, I'm not saying that's going to happen. I mean, it could be like a 1969 recession. We go down 20%, and that would be that. The average is 28%. So, but I think the stock market's misinterpreting the Fed's words. I've always said the bond market's the smart money, the stock market's the dumb money. The bond market with rates coming down is basically kind of acknowledging that things are slowing. Part of it could be they think inflation's, slowing down too, which is true. But oftentimes, if you have a booming economy, you wouldn't see rates come down like that. So as I mentioned, long bond rates, this is the iShares 20-year plus Treasury ETF. And you can kind of see just within the last month, really, it's doing well. So when it's going up, it means rates are coming down. It's an inverse correlation to it. And we got to the point where it is now crossed the little green line there, which is the 200-day. And you can see the little orange at the very far right. That's also the indicator, like it could be time to go from some shorter term. We've got a lot of money in T-bills, maybe go out, extend out a little bit. I'm not 100% confident in that, but we might start to ease into longer dated bonds come next year. But again, what I'm putting this up here to show you that usually during a recession or slow economic times, interest rates come down, which is good for bonds. Energy is starting to come down. This is the oil ETF. So it has really over the past month started to come down. Now, when bond yields are coming down and commodities are also going down, that's typically those markets saying, hey, the economy is slowing. If the economy was booming, we wouldn't have energy and commodity prices coming down. Again, unless the amount of supply is keeping up with the demand perfectly. So, or we could have a situation where the supply is just so great that prices come down because the demand's just not there. That's what I think we're seeing. So those two together typically spell slower economic times. But stocks have, especially this week, have had a good run here recently. Since November, they've started to kind of turn up. And so stock market's seeing it all, things look great. And maybe the stock market is right. It is a forward indicator. It is one of the leading indicators that we look at. So maybe it is right. Maybe the stock market's right and the bond and commodity markets are wrong. I don't think so, just based on my comment that the bond market is usually the smart one. But we'll see. We'll see. But the other thing I think that a factor that's kind of, this thing got a little messed up. Sorry, it overlapped here, but gold is going up too. Gold typically, gold doesn't really go up unless there's some things that are, let me fix this thing real quick. Unless things are getting a little dicey. So you don't typically see gold going up in great markets. I mean, you can, it's not perfectly correlated, but usually gold, I would say, is an insurance policy against chaos. It's also, sort of inversely correlated to the dollar. So that could be a factor in it. Dollars declined a little bit recently. But for the most part, when you have commodities going down and gold going up, that means there's a little chaos coming. Now, if gold's going up and the rest of the commodity infrastructure is going up, well, that could just be sort of a sign of inflation or just a booming economy. When you have all of them going up, when they're both telling a different story, you need to take note. Okay. Finish off with the lawyers say hi, as we always do. So if you're worried about this, you can read all of that. Okay, so I ran through a lot of stuff that I've already done, but I'll get into some of the moves. The one thing that did seem optimistic to me is in the stock market. I've been way underweight the stock market because it's been led by 7 stocks, and all 7 of those stocks are so ridiculously overvalued. It doesn't make sense. The vast majority, like 90%, 80% of the market move this year has been in those 7 stocks. It's crazy. But the past week or two, we've seen small cap stocks do pretty well, which is more of a telltale for the economy. Smaller companies tend to track what the real economy is doing. And we're starting to see the big 7 sort of struggle, and the rest of the companies in the S&P 500 do a little bit better. So maybe it is, and we might be easing into stocks a little bit more. If that continues, if we see that could be a sign that I've been wrong about the recession, and the stock market's been right. But we'll probably look, if we are seeing deflation, we'll probably move a little bit from the big amount of T-bills we have to longer dated bonds. We'll probably also we're going to add a little bit more to gold, silver, and the one I really like is the gold miners, because they tend to be sort of an accelerated play on the price of gold and silver. And I'll get into the moves on the next presentation. We're pretty much coming up on the hour here. I don't want to take up too much of your time. But right now, I still It hasn't hit yet, but the numbers are still getting worse, and we'll see what happens. If the leading indicators start to turn up, then I'll know we probably somehow avoided a recession. So those are the ones I'm really watching. Okay. Excuse me. Rob said he's been expecting financial collapse since about 2013. Yeah, it's one of those. I always look at it like I always talk about the Hemingway quote. Which book was it? I can't remember which one, but it was one of the characters, and they said, "Well, how did you go bankrupt?" He goes, "Well, slowly, then all of a sudden," and that's typically how it happens. It's one of those that it could take a long time for that to go. And I briefly talked about it at the last Coffee with Kirk when we talked about government debt. So there's really a couple things. It's a really long book, but it's a really good book. It's called This Time is Different by Ken Rogoff and Carmen Reinhart. They're two economists, and they basically looked at every hyperinflation, every economy that had a dollar or their currency crash, something like that. And they went all the way back to the 1700s, and they looked at trends. And there's two critical factors. One of them was when your debt to GDP goes over 120% on government, which we've hit, or actually it's 90%, over 90%. We're at 120% right now. So we're way past that figure that they look at. But what was sort of the coup de grace in most of the currency collapses or government issued debt collapse, going all the way back to 1700s. I mean, they looked at France and Great Britain, all that stuff. So it was debt to GDP over 90%, and then the amount of current expenses going towards debt had to be over 40%. We're not there yet. We're at about 20 to 22%, somewhere in there. So we have some time, and it could be a while before we get there, especially if rates come back down. But those were the two, like once a country went past that, once you're spending 40% of your tax revenue on interest alone, you're in trouble. So those two together were usually the signs. So we're not there. But the problem is if we don't rectify what we're doing now, we're going to get there at some point. And there's going to be other countries that probably get there before us. And right now we have two that are really struggling. China and Japan are having some serious issues. Okay. So Cindy, doesn't that prove free money doesn't work? Yeah, free money doesn't work. What all that free money did is it caused the inflation that we saw. So people got this free money and they spent it. And when the pace of the increase in the money supply outpaces the supply of goods and services, you're going to get inflation. And now that we're pulling the brakes back on the inflation, all that stimulus is gone and people are starting to really feel it. So yeah, it does. It has an impact. So anyway, we're coming up on the hour here. I hope everybody has an absolutely wonderful Christmas and New Year. We'll be in touch. And as always, if you have questions, I try to base this off questions that you all have. So please send them my way. But I really hope everyone has an absolutely wonderful holiday. So take care, everybody.